Okay, well, I think we'll get started because our presenters today have a lot to share, and we also have a lot of time set aside for questions. So I want to jump right into the content and our introduction. So I'd like to wish you all a good morning. And for those of you who are actually past morning, good afternoon to you. My name is Sarah De Levesque, and I'm Director of Regenerative Food Systems Investment. It's my pleasure to welcome you to our latest Regenerative Dialogues webinar, brought to you today by Iroquois Valley Farmland REIT. For those of you who are not familiar with Regenerative Food Systems Investment, or RFSI, as we call it, we were established in 2019 with a mission to scale up investment in regenerative agriculture and food projects. We work to gather diverse groups of investors, funders, farmers, entrepreneurs, and other stakeholders across the food and financial system to learn, connect, and collaborate to bring more capital to the space. Part of the way that we serve our mission is by curating opportunities to learn and connect, including through webinars like we have here today. And this year, in addition to these webinars, we also have 3 events planned, 2 of them brand new. So I just want to tell you a little bit about them because we're pretty excited. So our first RFSI Australia is already less than a month away and will be held virtually May 25th and 26th. Here in the US, the 25th and 26th. In Australia, that will be the 26th and 27th. Gotta love time changes and time differences in the virtual world. But that will allow us all to connect, Australians, people from the US, and people from all over. So the event is designed to catalyze both conversation and action around investment in regenerative agriculture and food in Australia and the Oceania region. The program will dig into the how of creating and executing finance and investment solutions that help further expansion of these systems and their positive impacts. The opportunity for investment and impact in Australia is ripe. We've been learning so much about it lately, and it's just so exciting to be a part of that community. So if it's a market that interests you, we hope you will join us in May. In June, we'll hold another first virtual event. It's called Rooted in Health, Investing at the Intersection of Regenerative Agriculture and Nutrition. So this is really exciting. I'm sure many of you in the audience understand the complex and intricate connection between how we do agriculture and what that means for human health. This event is really designed to dig into that. So we'll spend 2 days, June 22nd and 23rd, diving into the very underexplored connection between regenerative agriculture and nutrition, the pathways to improving human health through agriculture that already exist, the work yet to be done, and the investment levers that may be pulled to advance human health and nutrition through regenerative agriculture. Again, that is June 22nd and 23rd, and I hope you'll be able to join us for that. And in September, I cannot tell you how excited I and the rest of our team are to be planning our in-person flagship event, the Regenerative Food Systems Investment Forum, for September 28th and 29th in Oakland, California. So please save those dates as well, and crossing our fingers that we will again soon be able to see each other in person. You can find information about all of these events at our website, rfsi-forum.com. And then you can find information about other ways to continue to be engaged with RFSI as well. All right, so that's it. I promise that was the spiel I had for you all today. And now it's time to dive into why we are here today. Today, we have a fascinating conversation in store for you about how to create a mission-driven investment in agriculture. A big thank you to Iroquois Valley Farmland REIT for pulling this conversation together. I'm excited for all the information that they're going to share with you from their original vision and how it has evolved to how they have raised capital to support this vision. We'll also hear about how investment advisors evaluate investment opportunities and associated risks and how they work to align capital with projects. And finally, we'll hear 2 different agricultural investment case studies and how all of these pieces kind of come together and what's in store. So there's a lot to cover. So I would like to briefly introduce our panelists. Alex Mackay is the Director of Business Development and Investor Relations for Iroquois Valley Farmland REIT, an organic farmland investment company with a broad base of support from more than 400 mission-aligned investors across the country. One of Alex's claims to fame, at least among our community at RFSI, is that he presented at last fall's RFSI forum from his van after having been evacuated during last year's devastating wildfires. So he is truly committed to the cause here. He'll be kicking us off today. Tanya Steinhofer is a certified financial planner and chartered financial analyst with almost 20 years of diverse investment industry experience, including expertise in real assets and sustainable impact and socially responsible investing. She is passionate about her role, and today we'll be sharing her expertise and experience working with farmland investments. Claire Mesesan is Vice President of Farmer Relations at Iroquois Valley Farmland REIT, where she focuses on process, program development, and resource building. This involves collaborating with the team to support farmers as they move from intake into the pipeline and as they enter the portfolio. Today, she'll be sharing some unique case studies with us. So between the three of them, they have an amazing program planned, and we've also left plenty of time for questions as well. And so as I asked you all to, please do continue to introduce yourselves in the chat, but that's also where we'll collect questions as well. And so I encourage you all to ask questions as we go through the program, and I'll be compiling them so that we can kind of run through all of them and have a great discussion at the end. And also just a side note on viewing today. Since we will be using slides, we encourage you to watch in speaker view so that you can see both your slides and the speakers that we'll have spotlighted for you. So yeah, and if you have any technical challenges, also please use the chat function. I think that's covered it. So now without further ado, I'm pleased to welcome Alex, Tanya, and Claire, and we'll turn the floor over to them. Welcome.
Thanks so much, Sarah. I think we're going to start with a poll just to break the ice and also see who we have here today. Hopefully we have some insights for everybody. And so if you could just read this poll question and answer as best as you can about where you are in your regenerative food systems investment journey, whether you are actively in the space as a farmer or an entrepreneur or a fund manager of some sort or a thought leader, whether you're an active investor, whether you're considering starting a business or a farm or considering investment. I guess just take the best answer that you can find there. They're probably not perfect, but it would be awesome to get a little sense of who we have here. I'm going to say that I'm a practitioner and submit. And I think that that will help us with framing the conversation. We're going to have 2 more poll questions over the course of the presentation. We're excited to be here today. I just want to thank the RFSI, Sarah, Carrie, everyone in the organization. I find this is an extremely valuable partnership for Iroquois Valley, and I really enjoy the other webinars for learning myself. So I really do encourage you guys to follow the schedule and consider joining other webinars. I think this is a really amazing resource for people who are interested in this space. Today, we really wanted to talk to you about kind of what we're doing at Iroquois Valley with a little bit more concentration on all of the little pieces that make our ecosystem. So do some deep dives on kind of how we raise the money, who we're raising it from, our evolution as a company from something that started with 2 co-founders with an idea to something that is now broadly held by actually over 500 different investors around the country, something that continues to iterate and grow. So we hope that this is something that people are learning from and asking questions about, because really what we're trying to do, in addition to grow ourselves and impact the space, is to help others do the same. You know, I hear a lot from both our leadership at the company and from prospective investors in my job, how we need 100 Iroquois Valleys to solve the challenges that the people on this webinar care about. So we hope that this can be instructional and informative and something that continues to move the ball forward as we all work towards a more regenerative food system. So this is everything in Iroquois Valley in one slide. So write all this down and then we're going to end the webinar. That's all we need to do. It can take 10 minutes. So this is our ecosystem in an infographic, and Claire and I and others on staff have actually worked on making something that could tell the story of Iroquois Valley in one slide, because it's pretty challenging. There's a lot of stakeholders. There's a lot of different interests. There's a lot of challenges, and also there's a lot of opportunity. And so, what we're hoping to do today is get into, again, the nooks and crannies here and show you how all these pieces fit together. So on your left, you have impact investors. We would say at Iroquois Valley that the farmers are the most important piece of the puzzle, but the investors are certainly right up there as well, probably in second. We couldn't do it without the financial support and long-term mindset of our investors. So we as a company are raising money through two different securities. I'm going to talk about them and the way that we structure those securities, the way that we offer those securities, the marketability of those securities has continued to evolve over the company's history. But we raise money through an equity security, which is basically shares of stock where you become an owner in the company. And we also raise money through a private debt security, a note that right now is a 5-year note. But all of that money comes into our operating company. We're not a fund. We're not set up with general partners and limited partners. We're actually an operating company with a profit and loss statement, with audited financials that we have to file with the SEC twice a year, audited once a year, and financials twice a year. And with all of that capital, we are purchasing and financing farmland, most notably. We also do have some lines of credit. So our assets as a company are 95+% either farmland that we own and rent to farmers, or farmland that we have secured a mortgage for farmers on, where we are actually the lien holder and acting sort of like a bank where they're paying their mortgage payments to us. So our company revenue is coming from lease and mortgage payments. So we're getting lease and mortgage checks into our office in Evanston, quarterly, semi-annually, annually, monthly, depending on the arrangement. And that is our top line revenue. That's how we're funding our operations. That's how Claire and I are paid. That's how our lawyers are paid, our accounting staff. So we don't collect a fee the way that a fund usually would. And then based on the profitability of our company on an annual basis, we are creating a dividend for shareholders if we are profitable. And I'm going to get into how that structure works as a REIT. We're also servicing those notes that I talked about by paying our interest with that revenue. So it's a little bit different than I think a lot of the impact investments in the space of our size. You have a lot of venture capital consideration. You have a lot of traditional LLC consideration. Again, a traditional fund structure. And I think that there is a lot in the way that we've structured our business as it relates to the impacts that we're trying to create. So that's one of the things that we hope to link discussion, is this idea that the structure that we've arrived at has taken us, a while to come to, but it really does. It's structured in a way that can actually meet the deals on the other side that Claire's going to talk about later on, where we're actually partnering with farmers with specific, mortgages and leases that have risk sharing and prioritize the environmental and social improvement of the asset. As well as creating something that we can actually market to people like Tanya and other financial advisors and independent investors who are interested in getting involved in the space. So there's a lot involved in making all these stakeholders happy and interested. We're a work in progress, just like everyone else in the space, but it's been an interesting, series of innovations that have helped us arrive at this place where we can create, at least some satisfaction for all the stakeholders involved. So the company was founded in 2007 when these two gentlemen, in both pictures, actually, a little bit more traditional headshot on the right, but then that's them farming, watering sapling trees on a agroforestry operation just south of Chicago last year during a little mini drought that we had. These gentlemen started out really with just an idea around creating a real investment opportunity for people that prioritized human and planet health. So again, we've innovated a lot since then, but this was really a reaction to what they saw as degradation in the rural communities that they both came from around Chicago, where farmers were increasingly relying on pesticides and herbicides to grow and synthetic fertilizers. There was a huge increase in the amount of medical problems that farmers in the communities that they were involved in had based on all of that exposure to chemicals. Dr. Ravar, the gentleman on the far right in the picture on the right, is a physician, was an emergency room doctor, is now a vein specialist, still practicing. He saw over his career that there was a huge increase, I guess, in reference to one of the webinars mentioned in the beginning, in diabetes, heart disease, obesity, inflammation, all these issues around how the food we're eating was creating a significant decrease in the quality of the human healthcare that he saw in his life as a doctor. And then also the financial crisis was in 2007, 2008, 2009. And Dave Miller, whose career was in corporate finance and leasing companies, really, and banking, really wanted to give people an opportunity to invest in something that was a real asset, that was not just a paper asset, and something that could, be speculative and ultimately decay in its value in a very quick amount of time. So that was the motivation. And then since this, start of the company, we have changed in our structure over time to become a real estate investment trust. And that actually is a structure that doesn't force us, but allows us to have a broad base of ownership where people are sharing risk with farmers, where their liquidity is intermittent, where distributions are based on the company's profitability on an annual basis, and where they have to commit for at least 5 years. So those things are combining to create a structure that, satisfy a lot of our impact goals. So I realize I'm already going on a little longer than I thought for this opening section. So I'm going to cruise through some of these slides. Again, started as friends and family, people getting together and buying one farm that was converted by a local farmer to organic. When there was appetite both by farmers and by the investment community to grow this idea, the company combined into one LLC. In 2016, the company started scaling its fundraising through Regulation D offerings to accredited investors. Actually, that was, about 2013. But then in 2016, the company became a REIT because of the amount of people that were involved. It was more efficient for tax reporting. It offered the opportunity to offer investors a stable dividend over time as the company grew. And it seemed like the right thing to do to force this broad base of ownership. And then more recently in 2019 and all the way to today, we've actually expanded our offerings to include more retail investors. So it's gone from sort of this private, very specific friends and family structure all the way to something where we can offer a retail security with a minimum investment of $10,000 to both accredited and non-accredited investors. Today, we have investments in 15 states around the country. Our portfolio is still very concentrated in grains, which is really where we started in the heartland. In Illinois and Indiana, we're doing a lot of work with rotational and regenerative organic grain farmers. And we have expanded out as the company has grown, as we have the capacity to invest more, and as we've gotten a lot more interest from farmers all over the country. We have a combination of leases, mortgages, and lines of credit that you can see down here on the bottom right. Still we're fundamentally owning farmland as the business case for this investment opportunity. We hold USDA organic as our baseline for all the farms in our portfolio. I know that a lot of people are knowledgeable on this call around all the ins and outs of the organic certification, the Real Organic Project, regenerative farming. So Claire can speak a lot to that moving forward, but as a passive investment entity, we are not vertically integrated. We do not own we're not farming this land ourselves. We're supporting independent organic farmers who are doing it. So we had to create a structure where we knew that there would be some baseline of social and environmental improvement across the portfolio. Organic certification is a covenant of our leases and mortgages. And we fundamentally believe that as the only legally enforceable standard in the country for environmental improvement, that organic continues to be the path forward. This is the way that we create a relationship with these independent farmers around the country. Most of them are established organic operators who are looking to expand or establish new farms. We now have over 500 investors nationwide. The capital has come in many small pieces. The average investment is $100,000, but the range is from that $10,000 minimum all the way up to $5 million. And I love this scatter plot on the top left because it really shows how every single investment over the history of the company has come in. It's really been more and more additional to our original model of creating a broad base of ownership supporting this diverse group of farmers. So we're proud of that diversification of our investor base. We also have a lot of people who are investing in all kinds of different account types, which I think, sounds kind of boring, but is really actually important in my conversations around when someone's interested in investing, making sure that they can slot the money from the place that they want it to align with this investment, a retirement account, their revocable trust, their foundation account, a family office, et cetera, et cetera. And one of the big ways that we raise money is through financial advisors. So we have a great network of financial advisors that I'm going to show in the next slide, but you can see here in our fundraising over the last 6 years that financial advisors have comprised a significant chunk of all the money we raise. And, if you can establish a relationship with a financial advisor, really have them do a deep dive on you, all your diligence documents, and understand what it is you're doing, what value you offer, and what risk you are to their clients, that can be a really efficient way of helping to raise capital as you grow, because they're going to be, a business development person for you if it's appropriate with their clients. And that is an efficient thing for raising capital. And I have to say, in the farmland business, efficiency is key because it's just a low yield investment. And you really have to be lean with how you spend your money in order to create any investor return. So this is a group of some of the financial advisors we work with. This is on our website. It's public. We have no paid relationship with any of these people. They've just agreed to be, marketed on our website as having clients invested with us. And our next speaker, Tanya, is right there circled at Redwood Grove Wealth Management, and I can let her introduce herself. This group has grown significantly in the last 4 or 5 years. And it's been really great to have the ecosystem of investment advisors move towards us. I'm one of the things I'm optimistic about, which, there's plenty to be pessimistic about, but one of the things I'm optimistic about is how much the market is moving towards impact investments. And, it really is an amazing thing when someone finds you on the internet, finds your website, reaches out to your email address or your online form and says, I have clients who would be interested in your investment opportunity. And we'd like to have a conversation about what it looks like. That is something that I think everybody in this space needs more of. And so it's really exciting that we have these mission-aligned RIAs and financial advisory firms who are looking to really do extra work in order to get their clients placed in something that is not as easy as to buy as a publicly traded security or mutual fund. So with that, I'm going to throw it to Tanya, and I will just move this to her slide and let her take over and get a little bit of an introduction on her firm and how she found us. And then me and her are going to have, I think there might actually be a poll we're going to throw up. Sarah, maybe you can answer the first poll and then we can throw up the second poll questions.
Yeah, and my colleague Carrie shared, it's a little, scroll up a little bit in the chat. She shared a screenshot of what the poll results looked like.
Never mind, sorry.
Oh no, it's okay. You were busy informing all of us. Did you see that? Do you want to read it off, or would you like me to?
I can't see it, but maybe just give a quick rundown would be great.
So the question was, where are you on your regenerative food systems investment journey? And we had about 94% of you voted. Thank you. At the last minute there, we got some last minute ones in there. 49% of you said that you are an active practitioner. 26 are active investors, 26% that is. 19% are considering starting a farm business or investable opportunity. And 29% are considering an investment in the space.
That's great. Well, that means there's a lot of people probably looking for funding. So hopefully we can continue to evaluate that and also, illuminate that, and also illuminate, how we evaluate deal flow when we're looking to fund a farm. So with that, I'll throw it to Tanya.
All right. So a little bit about me and my firm. I run a financial planning and wealth management firm in the Bay Area, just north of San Francisco. We serve about 60 client families, representing almost 100 million in investment assets. So that's an average client size of about $1.5 million. There's 3 of us that work at the firm, so we're a pretty small firm, and that's going to influence kind of how we approach private investments and impact investing, because we're small and don't have the resources of the larger firms. You'll hear more about that in a second. it wasn't always this way, but we've become more kind of encouraging of clients to do ESG and impact investing. And so today, 80% of our clients are invested in ESG, sustainable, and/or impact investments. Another part of our kind of who we are as a firm and our journey is that we became a B Corp. Iroquois is a B Corp. We became a B Corp in 2019. And we also belong to 1% for the Planet, which requires us to donate 1% of our revenue each year to environmental nonprofits. So those are other things that kind of influence how we think about investing and our role in our communities. So I've been interested in socially responsible investing, as it used to be known, since I entered the investment industry back in the late 90s. And back then it was mainly around, and this is mainly in the public stock market and public investment markets, but SRI investing was really about negative screening out of companies in certain industries that were deemed sin stocks. That's changed a lot, and the industry has evolved and grown, and there's a lot more investment choices, and it's shifted to more positive screens to look for companies that are doing well on environmental, social, and governance metrics. So it's gotten a lot more positive oriented. There's a lot better choices out there. And so since I launched my firm in 2009, I've included as part of my client discovery process a conversation around whether clients are interested in this type of investing. Initially, not as many were aware of it or as interested as I had hoped. But the industry, because it's become much more mainstream, you read about it a lot more, it's become much more common. More and more clients are interested in it and know about it. And as I mentioned earlier, now 80% of our clients are invested in this way. So a few years ago, I both started encouraging more of my clients to do ESG investing, but I also, I took a class and became aware or maybe convinced that traditional public market investing may not be enough to address kind of the reality of the world we're living in today, where climate change continues to worsen and its impacts are just felt more broadly and becoming more severe. And so through some classes I took and books I've read, I've just become concerned that our modern capitalist economy and the markets have really become a burden on our planet's resources. And we can't just continue doing things the way we've always done them and investing the way we've always done it and expect kind of market rate returns. I don't know that traditional public market investments are going to generate the same returns that they generated in the past going forward. And so part of that journey, I started to look for more social impact, investments, many of which are in the private markets, because I felt like that was a better way to allocate capital and really tackle some of the problems that are out there. However, as I alluded to in my intro, I'm a small 3-person firm, and we just don't have the resources to evaluate tens of and hundreds of private investments and do the paperwork that's involved and track them and report on them. And so I've had to be very careful about how we proceed on this journey. Now, I learned about Iroquois from the teacher of a class I took on values-based investing. He had done the due diligence on Iroquois and has an institutional investment background. So I really trusted the thoroughness of his work. And then another firm that I respect, which you saw on the bottom of Alex's slides, Impact Assets, they have a list that they maintain and monitor each year called the Impact Assets 50. And so they had done due diligence on Iroquois and approved it to be on their list of the top 50 impact investments. So by relying on the due diligence of other respected entities and people, I was able, and doing a little my own due diligence, I was able to get comfortable investing in a private impact investment like Iroquois. So that was able to overcome one challenge for private investments, which is the due diligence factor. The other thing about Iroquois that made it easier to kind of get over some of the logistical hurdles are that their equity shares have a CUSIP, and it can be held at TD Ameritrade and some other large custodians. And TD Ameritrade happens to be where my clients' assets reside. So it made it easy for us to put the investment in my clients' existing accounts. And then that way it's reported on and it shows up in the same report with the rest of their investments. So that was another logistical challenge that for a small firm like mine, we were able to overcome with Iroquois. The final kind of challenge or hurdle to investing in private investments is really the paperwork. It's nowhere near as easy as just buying a mutual fund or buying a stock. So there's a fair amount of paperwork that's involved. And I've decided that, I think Iroquois makes sense for a certain group of clients, not all of them. And so I'm willing to kind of deal with the paperwork hurdles for that small group of clients. Now, how I decide which clients Iroquois is appropriate for, in my mind, they have to be fairly investment savvy to be able to be comfortable with the illiquidity, and Iroquois has a 5-year initial lockup of these private investments. And then they also have to be pretty passionate and interested in either climate change and or human health and nutrition. So that kind of narrows my pool of clients that I think it would be a good fit for. Another thing I do when I'm considering doing private investments, and I really don't do many, like Iroquois, and I use the Calvert Community Investment Notes. Those are kind of my two private investments or ones that don't have daily liquidity. But the other way I manage risk is I only allocate a few percentage points of any portfolio. And that just helps both me and the clients know that, if something goes wrong, we're not going to expose a large portion of the portfolio. Now, in terms of adding kind of new money to an Iroquois or another private investment, I really kind of treat it as I treat the other investments in my portfolios, and I have kind of a systematic rebalancing process. And so I only, I'll add money if it has fallen to less than 20% of below its target. And that's the same range I use with my other investments in the portfolios. And so I have, because it only gets revalued once a year and the stock market's gone up so much over the past year, I have had to add new money for a couple of my existing clients. Another question that often or sometimes gets asked is how I handle impact reporting as an investment advisor. And I, because of my small size and limited resources, have not gotten to a place where I'm doing a consolidated impact report for clients that are invested in Iroquois and other ESG or sustainable investments. It's something I aspire to, and it's something that the B Corp assessment asks about. So I do have it kind of on my radar screen to develop some sort of impact reporting, just not quite there. That said, for any impact or ESG sustainable investment that creates an impact report, I forward those on to clients. So they're getting some sense of how their money is having an impact in the world. And I think that's important. So I think that's all I kind of came up with as things you might want to hear initially from me. Alex, where do you want to go next?
Well, I just wanted to ask a couple of quick follow-ups, and then we can pass it to Claire. But I just think one interesting thing that we probably both have experienced based on communicating this to prospective investors, because we've both done that, is like the difference in sort of the type of conversation it is based on all of these factors: private, small, illiquid, impact first. Do you have any points of view on sort of, even if it's just more qualitative than quantitative, how that conversation between a prospective investor goes when it's around something like this versus, a traditional investment? Is there any knowledge there that people who may be considering raising money, either from advisors or even if they can't yet, but from venture capital or angel investors or, doing some sort of LLC or fund, any insight on what that conversation is like and how it's different based on traditional investment conversations?
So the way I work with my clients is they kind of outsource discretion over their investment portfolios to me. For something like a private investment, I'm not just going to make it without consulting them, but they kind of trust me to do the due diligence and propose ideas to them that I think are a good fit and a good investment option for them. So my clients don't typically ask a lot of detailed, thorough questions, whether for a private investment or a mutual fund I might propose. But I think they should. I think, if I had my perfect world, they would ask a few more questions so that I understood that they really understood what they were investing in. That said, I do think, like me as the person that's doing the due diligence and investments like Iroquois that are trying to raise capital, you do need to be prepared to answer a range of questions to get potential investors comfortable with the investment opportunity, whether it's the track record of the management team, what's their experience, what that's related to this investment, and what kind of returns have they generated in the past, how is the investment structured, what are the liquidity requirements, how are you managing cash and making sure you have money for redemption requests. You know, there's a variety of who are the other investors, what's the expected return from the investment. You know, I think the more you can have your story down and buttoned up, the better the fundraising efforts will go.
And I guess one other question is, and I know you're not an analyst of the RIA industry, but have you noticed in your experience as a registered investment advisor, financial advisor, you know, a lot of the administration and paperwork you talked about has actually been my focus at this job. It's not necessarily about whether people like what we're doing or want to invest. It's actually about whether they can invest structurally, whether, you know, their IRA that's held a certain custodian can get to us, whether their financial advisor has the ability to recommend something that is private and illiquid, et cetera, et cetera, et cetera. So I think those things are very fascinating because people in our space need to figure all of those, I guess, more boring things out in order to really understand how to raise a lot of capital. So do you see any movement in the space that suggests that, I mean, I feel that, I guess it's a rhetorical question because I feel firms like you guys investing in us is a great illustration of how it's changing, but could you comment on how maybe the traditional money management market is moving increasingly towards this, including being willing to fill out paperwork and things like that? Are you optimistic about this becoming more and more normal for more and more financial advisors?
I mean, I think it really depends on the firm and their setup and resources in terms of whether they're willing to kind of do the due diligence, do the paperwork, report on things separately. And I don't, not kind of as you mentioned, being an analyst of the industry, I don't know what new technologies are coming down to maybe make the consolidation and reporting easier. But larger wealth management firms might have a department, and my former employer is an example of this. They have a whole department of people dedicated to evaluating private and impact investments. And so they're just going to be more comfortable and more likely to make a variety of private impact investments and accept that it's going to involve extra paperwork and reporting challenges. Smaller firms like mine, on the other hand, you know, anything the private investment world can do to make it easier on us. And I think an excellent example is you guys going through the hassle of getting set up so that you have a QSIP and you can be held at TD Ameritrade and Schwab and Fidelity and wherever. You know, anything you can do to make it easier on smaller advisors is just going to increase your potential universe of investors.
Okay, great. Well, thank you. I really appreciate all that information. And I think it's really important for people to understand that when you finally get to a place where someone's willing to invest, that it might be that you have to figure out how to get the money from their bucket into yours. And it's not always easy. They might be completely committed to your vision and your mission and your financial return story, but it still can be a challenge. So there's a lot to learn in the weeds of how wealth is managed. So with that, we can go to something that I think a lot of people might find way more interesting than I do about financial advisors, which is the farms themselves in the Iroquois Valley portfolio. Thanks for bearing with me on those sort of dorky questions about all of the ins and outs, and I'll throw it to Claire and move the slide. And there is going to be Q&A at the end where we can circle back to Tanya's experience and any recommendations she has for people. And we got one more poll here before we start. What experience do you have with deals in the regenerative food space? Let's get a sense of how much people understand in this space.
Thank you so much for so many great questions in the chat. I'm I've been taking notes on them, and I'm going to try to weave some answers into the topics that I cover. I think I'll just start from the beginning though and say what Iroquois Valley does. So Iroquois Valley, when we started in 2007, the founders were noticing that a lot of young farmers were facing barriers to entering agriculture. There's a lot of research out there about the climbing age of a lot of farmers, and there's a lot of issues around farmland transfer and getting more young farmers on the land that a lot of organizations are studying. But what we were seeing was that in the Midwest, in Illinois, where we started, there was a whole group of young farmers that were cash strapped, did not have any equity, maybe were the third or fourth generation farmer in their family, and were struggling to get on the land with increasing land prices. So we started with leasing because of those reasons. So with farmers being cash strapped, with them having no equity, they were not a great fit for mortgages. They were not great fits for some of the government programs because of their lack of experience on the ground, and not having maybe a 5-year business history. So they were just looking for cash to get started and land to do that. We structure our leases so that farmers always have the opportunity to purchase land after a certain amount of time. So we deem that 7 years. That is not an end-all be-all time period. Farmers can purchase at 7 years or thereafter. Otherwise, we'll just continue in an evergreen lease situation. So one of the other really clear issues was organic agriculture. So yeah, we can go either way on that, but on that slide at least. So organic agriculture is, requires a 3-year transition. Again, for young farmers who may be cash strapped, that's going to really affect their balance sheets. That's going to make them potentially look very risky to traditional ag banks. We wanted to structure our lease to have a subsidized period during that time, so that they were able to focus on the transition, get that underway, and then as their transition becomes certified organic acreage, then the lease rates will move from a subsidized to a rate perspective. So someone was asking about the differences for the farmer between renting or owning farmland. And honestly, it really just depends. The farmer may be in a situation where a lease is the only thing that makes sense for them. We offer refinances, so we can sometimes get into situations where the farmer is just looking for a refinance. There are certain laws in different states about corporate ownership that makes it impossible sometimes for us to even offer our leasing product. So mortgages allow us to be more flexible and respond to different kinds of farmer needs. So we can go to the next slide. So this is actually a great representation of a 5-phase kind of process for farmers in our pipeline. So I think contrary to a lot of maybe public perception about investing in this space, we never look for specific land to invest in. We're not looking at soil surveys. We're not looking at land first. We are always responding to a specific farmer need. So farmers will approach us with an opportunity like the land that adjoins their existing acreage is up for sale for the first time in 30 years. They'd really like some capital to get on that land and expand. It could be a farmer who has been managing land for years and is looking to finally establish their own operation, and they've found the specific piece that they'd like to do that on. We think that the farmer needs to identify the land that makes sense for their business, and so that is how we start. In our initial conversations, we'll also get a sense for their commitment to organic, their commitment to other practices that build soil health and can be, defined as regenerative. I think that was a question about how do we define regenerative. So obviously we start with organic. a lot of farmers we work with self-identify as different kind of, I guess, practices that they like to support. We have farmers that might call themselves carbon farmers. We have farmers that identify with the regenerative movement, some who prefer talking about soil health and conservation more specifically. They also might carry additional certifications on their land. We have a few who are Real Organic Project certified. We have a few who are exploring the regenerative organic certification. We have some that are doing the ecological outcomes verification from Savory Institute, and a few that no one has yet certified as biodynamic, but we do have a few people exploring that at this point. So those are the very early conversations we have to see if people are values aligned, to see how connected they are to their communities, if they have other folks they're working with in the organic space. Because organic is still so small, it's really important for us to see that farmers have a connection to other organic farmers, to really just do farmer to farmer learning and to make sure they're part of some community, because they may be the only organic farmer in their county. So then if all of that checks out, we move into kind of an early due diligence process where we're just checking their business plan, a credit report. We might be getting some preliminary property information, and maybe we'll start ordering an appraisal at that point. If all of that continues to look good, then we'll move into a final due diligence where we're looking at tax returns, we're looking at 3-year cash flow projections, a very detailed balance sheet. We'll go out and make a farm visit, which has been somewhat challenging during the pandemic, but that is a key part of our due diligence typically. And then all of that is just to make sure that the farm business can support the lease rate, the loan rate, whatever product we're dealing with at that point. So really with that, we're very agnostic to whatever kind of business they're running. We have a pretty diversified portfolio of, it might be a long-term crop rotation, it might be super diversified with crops and livestock, it might be a dairy operation, there might be some vegetables included. And all we really need to see is, do the numbers pencil out, and can they support the product that we're working on? So with that, we'll move into closing, which can be another process that has been lengthened thanks to the pandemic, just because of appraisal times and legal issues with title insurance and a lot of surveying. And so we'll get all that squared away. And then our last phase is really just onboarding. So in the last few years, as the portfolio has grown, we've developed a relationship manager function, which means that every farmer is assigned a relationship manager who is there for them to answer any questions, handle any challenges, and also provide any opportunities that they may be aware of that we're thinking about, like programs we might run, helping make sure that they're participating in that. And so that is really how we're getting to the last part of creating an investor return and creating all of those impacts. And yeah, Alex makes a good point in the chat about how we have not sold a lot of land to farmers. Again, that speaks to the pros and cons of owning farmland or leasing farmland, because if folks are interested in continuing to expand, leasing may be a great way for them to not take on a lot of exposure to that themselves, but still get that land access to impact their business and get more acreage under their belt. And so we try to be as flexible as possible. Of course, if anyone wants to buy the land, we're happy to do that. If not, we're happy to reinvest with them and help them get more land. So a lot of our portfolio actually is represented from reinvestments. So we can go to the next slide. So here is a great case study. The two that I'm going to talk about are fairly recent. So we made this investment in fall of 2020 with Rehi and Amy. They are based in Minnesota. This is kind of one of those stories of very long-time practitioners. A lot of you may be familiar with Rehi. He is doing amazing work with the poultry-centered regenerative system that he's come up with. He has implemented that system, kind of all over the world. He's originally from Guatemala, and he's an indigenous farmer. And finally, he wanted his own large piece of land to really do the system for himself. And so previously, he had been on just over an acre, I think an acre and a half. And now he has about 76 acres that we supported through a mortgage. So this is a situation. Minnesota is a state where we cannot own any farmland because Minnesota has anti-corporate ownership states or laws. And so we are only able to offer a mortgage product. So this actually functioned as a purchase. So it was a loan for the purchase amount. Sometimes we also do refinances, as I said, but this was effectively a loan for a purchase. And I think this took, probably 4 months, start to finish, to close. There were, we were fundraising, Rehi was fundraising, and we were trying to support through our network around a down payment and getting the loan to value up to an amount that our investment committee feels comfortable about. That's also part of the closing process, is getting approval from our investment committee or board. And so we present an investment report, and we have certain ratios that they want to see. And so even if folks aren't necessarily where we'd like them to be, or where the financials look, really solid, we will continue to work with them and do what we can to get them to those levels. So I'm going to just pause for a second and see, did we ever get that poll result? Because I also want to read some of these questions that are coming in and see if I can speak to them live. Cool. Okay. So I don't know if that means I've never done a deal in this space and I want to, or I've never done a deal in this space and I'm probably not going to, but.
Bad poll design by me.
Yeah, we'll see. I think then hopefully there are going to be lots of clarifying questions. So I would be interested to hear also from the 26% of people represented that have invested capital into this space and see what they're thinking about. So great.
Do you want to go to the next? Oops, I just did. Okay.
No. I'm sorry. I'm reading this question, and I do actually want to speak to it. So the tension between renting and the fact that renters can only make limited investments in infrastructure on rented land. So we actually have a provision in our leases because we own the land for capital improvements. And typically we like to invest in things that are not going to be super depreciable. So we're likely not going to be investing in greenhouses or, permanent infrastructure so much, but we have invested in fencing. We've invested in some hoop houses, and we try to think about that because as a company that's making these investments, our entire valuation is based on appraisal. So if we feel the investment is going to create appreciation in the property and it's obviously going to support the business, we will consider that and make it. We also have this provision, and I don't know if Alex is going to talk about this at some point, but our debt product, the soil restoration notes, has a provision called the soil restoration pool, which is actually taken from the investor return and diverted into a pool that supports our farmers. And it's basically an in-house grant making program. And so we support a lot of projects that support soil health or conservation, including infrastructure crucial to operate regeneratively, as that question said. Again, like fencing, again, like soil testing. We've supported purchases for mulberry bushes to get a silvopasture system, let windbreak off the ground. And those are some of the tools that we have to support some of these issues. So that's kind of what we see. So Salvatierra Farm is, just to wrap up there, this is a newer relationship. This is kind of that case of practitioner to on the ground farmer, and it is in transition. The farm that we bought had previously been conventional, and they are on the ground now planting some cover crops to get that restored. So they are entering their first year of transition. So we can move to the next slide. So Prairie Grass Ranch actually just closed earlier this month. It is super fresh. These are some amazing farmers in Montana. I am their assigned relationship manager, so I can speak pretty in detail about this. This is a different kind of situation. So this is another mortgage. We could have, probably put a lease up here, but I wanted to do the really fresh ones. This is a situation where the farmers wanted to retire a loan that they had with their current bank and a line of credit. So we ended up doing a cash out refinance to support that need. And so we are exposed to the 3,600 some acres. They have additional acres that they rent from family or from other landlords. And so their entire operation is close to about 7,500. They are doing a long-term crop rotation, and they are raising cattle. And last year they did their first test acres of Kernza, which some people might be familiar with. It's a perennial grain developed by the Land Institute. It's in the long root ale beer that Patagonia puts out. And it's really exciting because grains grow on an annual schedule. And so that requires a lot of equipment and annual plantings. And so having a perennial grain and seeing how that works has a lot of promise. They did their first test acres last year. They're doing more this year. And it's part of a kind of 10 to 20 year vision to really incorporate it throughout their operation. At this point, they're growing it primarily for seed, but it's being interplanted with their lentils, and the cattle will actually use it as a forage in a first pass. So it's a pretty exciting system. It's really exciting to be part of supporting an operation that has such a long-term vision. And I think that, sorry, my thought just went out the window, but this is a really exciting operation. We can go to the next slide. Oh,
so we're going to wrap up here quick because we're running a little over and let people ask questions. But just to sum all this up, going back to that ecosystem infographic from the beginning that I know you all wrote down, how is this working for all the stakeholders is really how we want to wrap this up. And, one of the most important stakeholders, like I said in the beginning, is the investors. Without them, we can't continue to expand our operations, scale the opportunity, and ultimately create more and more impact while also, converting more and more land to organic. So our company has continued to grow successfully over the last 12 plus years, 13 plus years. And, the major metrics that people are looking for us are dividends and the appreciation of the land. So what you do when you buy our stock, which is more than 70% of all our fundraising, your returns as an investor are the value of that stock over time, which is a reflection of the value of the land over time, and any cash distributions that we do. And so our stock price, which is in the bottom right and is going to change on Friday for our annual valuation, so there'll be a new data point there, is very reflective of land values in the United States during this time period. So if you were to layer that graph on top of a USDA graph of farmland values, it would be very consistent. And so for us, as we raise money, it's really important for us to communicate safety and stability to investors. This is obviously a very innovative company. We're doing a lot of really important work. We're taking a lot of risk, but at the same time, we've been able to create a system where we're securing that value through the value of the land. And so I think that that's a really big help for us to be able to communicate to investors like Tanya that even if our farmers have a bad cash year, if the variable rent that Claire talked about isn't coming in because of weather issues, because of crop prices, maybe somebody's having a harder time during that organic transition. So they could be a payment or two behind, whatever the case might be. There's still a lot of value created in this share price. And so I would just encourage a lot of practitioners who are trying to figure out how are they going to raise money from people. Is there a way to secure the value into something stable? And I think this is one of kind of the most important parts of the Iroquois value proposition is ultimately people are getting exposure to the land. That is what their fundamental investment is. And then all this other stuff is amazing and the bells and whistles are great. But ultimately that's the safety net. And so our dividends, we would really like to see closer up to 2+%. The dividends are very reflective of the revenue and our cost structure. So as we grow, as we scale, our shareholders have decided to share risk and really ultimately compromise on their cash dividends as we're trying to get to a place where they can be more stable and consistent over time. For our farmers, I'll throw it back to Claire and maybe we could just zoom through these last few slides. Actually, I'll do this one, Claire, and then I'll throw it to you. So, we are really trying to, again, be this passive entity that is reacting to farmers who are managing their own businesses, managing their own farms, making their own decisions. We are supporting them with the financing for the land access and operating capital, but we are not meddling in their opportunities. And so we really want to stay clear on that we are supporting the business of farmers running their businesses. We're very much looking at the farmer themselves as the risk factor. We are having personal conversations with these people. We're not speculating on the value of land. We're not looking at any sort of like hedging against, certain market risks or buying up land in order to secure water rights. We're really looking at, is this operator going to be able to continue to expand and successfully keep their business afloat and service the debt or pay us our lease payments? I'll throw it to you, Claire, for these last few environmental slides, and then we can open it up for Q&A.
Yeah, thanks. I remembered the thought that went out of my head, and it was someone was asking about the scale that we support. So we do support farmers at all scale. I like to say that we're at every level of the food system. So the farmers you see in the farmers market, we support those. The farms that are producing the food in Annie's mac and cheese, we support those. The farmers that are vertically integrated and growing their own grain and milling their own grain for flours, we're really represented across the board. And so all of this really ties into the impact. So how do we measure our impacts? Well, we're looking at farmland that is under organic management. We're looking at soil health metrics, which we've developed in the last year or two and started reporting on in the last year. We're doing a portfolio-wide analysis on practices that build soil health. So how many of our farmers are engaging in cover cropping? How many of them who have livestock are doing rotational grazing? How much tillage is happening? Is anyone no-till at this point? We have a wide variety of metrics that we're looking at. And more than that, I think we can go to the next slide. We are a certified B Corp. We actually just we submitted our assessment in February for our third assessment that happens every few years. We've been certified since 2012. That is an independent measure that we're verified by. We're hoping to see our recertification process is not complete yet. We still need to do our interviews with B Labs. And so we are also listed on the IA50, as someone has mentioned. That's a list of impact investments in the space. We've been independently verified by Eris Insight, that basically our impact strategy is reflected in our actual impact practice. And so, coming back to B Corp, we have been named as a best for the world company, which means that we're in the 10% of all B Corps scored. And so hopefully we'll keep that with our new score once that gets verified. So we have a wide variety of metrics, and you can find more on our impact page on our website.
So I think that's going to be it for us, and open it up to Q&A. And I think it really does dovetail with what Tanya was saying about how she's also a B Corp. She's 1% for the planet. And, there is this community of practitioners here that are busy and trying to do as much work as they can. And a lot of those certifications or groups like this, networking can also be incredibly important. I saw some questions around how to raise money for, big operations in aquaculture and things like that. And I think, I know that Dave and Steve, when they started this company, started out in the very same place where they had to play in the sandbox of people that they wanted to be around and to support and to raise money from. And, moving forward, that really does actually have a positive impact, so that when Tanya's looking at us and we're understanding Tanya's firm and other firms, that we are mission aligned. It doesn't mean necessarily that our clients are going to invest, but that the conversation and sort of the environment with which that we engage with one another is, I think, on a similar footing. And that's really important as well. So all this stuff feeds into each other. I actually have one question for Tanya around that aqua that's related to the aquaculture question. And then Sarah, maybe you can add some other questions. So Tanya, I find sometimes that it's not that there's a lack of money for ideas, it's that people are asking for the wrong money, that the people who need money are asking for people who can't give it to them because of structural or size or risk, and vice versa. Do you have any sort of and you touched on this, but I guess just to hammer home that point, a bunch of people with venture capital ideas shouldn't come to your office and ask you for money, because that's just not what you do. So do you have any sort of broad statement on that idea of when someone can actually approach a financial advisor for money? When would you think that was, if there are some big broad answers to that, what would they be?
I mean, I think understanding the investment advisory landscape and the type of investing different firms do, like some firms do VC investing because they work with very high net worth individuals and have a program to invest in small venture capital deals, and then other firms don't. So I think just doing your due diligence to understand how different investment firms and financial advisors approach investing.
Yeah, no, it seems like a simple piece of advice, but I feel like a lot of people spend a ton of their resources and time asking the wrong people for money. And it's not that their idea isn't good or that there isn't an opportunity there, but that there's no way that would ever be a yes. And so either that's been me asking the wrong people, or that's been people asking me for money, thinking that I actually invest money versus raise it. So I would just encourage people who are practitioners on the call to really take the extra moment, instead of just doing scattershot of asking every single person that says they're into regenerative ag for money, that you really do what Tanya said and figure out who actually has the capacity to look at your opportunity and raise money from it, because ultimately you're going to spend so much less time spinning your wheels on no's. When people might spend a ton of time learning your idea and stealing it, but not necessarily giving you any money. So anyways, I just thought that was interesting.
Great. I will hop in here. We had amazing questions from our audience, so thank you all for filling those all in our chat. I know that the team was answering some of them as we went along here, so I'm trying to weed through those. But I wanted to revisit, you guys gave a good summary about how you're measuring impact and what is important to you. But there's one thing I wanted to follow up on, and Cole asked this question a couple times. So Cole, do speak up in the chat if this isn't addressing the question yet, or if you're still looking for more answers. But I was wondering, especially as we titled this session, triple bottom line, I know you guys have a great soil health report, I believe you guys did a while back, and you're measuring soil health metrics. You talked about organic standards, practices, B Corp. But I think when we've talked in the past, we've talked a lot about kind of the impacts you have on the communities that you're investing into, the farms. Wondering if you have a way to measure that, or if it's qualitative. How do you guys look at that?
Yeah, that's a great question. I wish we had more hard metrics, but a lot of what we get are stories. And I'll just put in the chat again, because I had sent it at some point to someone. This is on our communities page of our website, which is under the impact tab, we have this white paper that really touches on how we think organic agriculture investments can impact a broad range of topics, including rural communities. So there, I think like one of the studies that we continuously spotlight came out of the USDA around organic hotspots and how the rural economies can actually grow according to the amount of organic farms that are in the area. So building wealth in that region. And so that is one data point that I feel like really speaks to that topic. We know that organic prices, tend to be higher than conventional prices. So when we look at the human impact, we do think about farmer profitability and farmer viability out of that. We also think about the food that they're growing and that getting into the marketplace. So we look at the growth of the organic industry as well as spotlights. And so, we're working on quantifying all of that more specifically to our portfolio, especially around soil health. We are looking at soil organic matter. We actually did a case study for a farm that we work with in Montana around valuing ecosystem services. We actually just got the preliminary numbers back on that this week. And that entire methodology that will be coming out eventually, that we'll be sharing. So I guess look out for that. But that methodology is definitely still emerging. That was with Earth Economics. So I would look them up and see other case studies that they've done because they have some interesting data. This will be the first one that we have worked with them on related to our portfolio. So yeah, it's growing. Hopefully we'll get there.
And that's yeah. Go ahead, Alex. Sorry.
I would just add, so I get that question a lot from individual investors, from advisors. And I think someone I saw in the chat was talking about what is regenerative ag. And Sarah, I think you said at last year's forum or 2 years ago that there is no agreed upon definition of regenerative ag right now. Maybe you didn't. But anyways, I would say that like conventional chemical agriculture is perfect for metrics. They know exactly how many acres, how many seeds, how many, gallons of fertilizer, et cetera, et cetera, et cetera. And regenerative ag, without being an expert in it, the spirit of it is ultimately sort of mimicking nature and the beautiful confusion that exists in that space. So if you think about our portfolio being all these different farmers in all these different places, growing a lot of different crops, even if they could be lumped together as, livestock or grains or legumes, and then the different sort of soil and weather patterns that exist there and all these different things. Ultimately, I have to get people, when they're asking about metrics, to understand that we're working on it and that we're doing the best that we can, but that really what they're trying to support is something that is less systematic in nature, at least at this point. If there might be a robust system of metrics that continues to develop, but even some of the carbon sequestration optimism has been a little bit tempered recently based on whether or not actually the measurements are accurate. And we actually had a trial of the Comet Farms product that didn't go very well for us, just based on a lot of different things. So I think when Claire says, this will come out and we're working on this, that a lot of investors in this space are satisfied by the fact that we're doing a lot and that we can look forward to continuing to do more. But that ultimately, if we spend all our money tracking things that may or may not be as accurate as we hope they are, that there are other parts of the company that are going to suffer, like their financial return. So it is what it is. We hope to continue to improve, but it's not as simple as a matrix of metrics that people can look at on a sheet and say, okay, these guys are regenerative.
Yeah, I see a follow-up about why Comet Farms didn't go super well. So this was in 2016. I know the tool has adapted. And really the basic answer is that the farms that we were modeling with it were too complex for the Comet Farm system. So these were 5 to 7 year rotations of about 40 different crops, including cover crops, including pollinator buffer strips. And at that point in time, Comet Farm was really looking at more simplified systems. And so we were not able to get, there just weren't models to work on the level that our farmers were working on. So we weren't able to put good data in, and we definitely didn't get good data out. So if it was just an organic corn, soy, hay rotation with maybe no cover crops, maybe that would be a better tool. Maybe it's time for us to re-explore that and see how they've evolved over time, because I know they have. But it just turns out, especially someone else had asked about, are farmers getting multiple revenue streams through carbon sequestration? Because their systems are so complex, that has actually presented a lot of challenges for them in getting in on these markets. And we hope that changes, and we do believe that'll change, but it's made it a little bit kind of ironic that the more that they're doing that's probably considered regenerative or conservation oriented, the harder it is to work with that.
Great, thank you for that. Very thorough question, just because I know we have a large portion of our audience, or a decent portion of our audience, who are more on the farming side and project side. How do you guys source your farmland investments?
To date, we've always had, I say this a lot, we've always had more farms to fund than we have money to spend. So that doesn't mean don't contact us, but it means that we get leads through presentations like this, the Moses conference, other online webinars, our website, a lot of word of mouth, farmers in communities talking to farmers. We do a lot of reinvestment with existing farmers. So a farmer will oftentimes own their own land, then lease a property that comes up for sale abutting their land from us, or we'll buy it and they'll lease it from us. And then a third property across the street might come up and they want to expand the farm more. So we do a lot of reinvestment. I think, we continue to say, and this is something that our CEO and founder says, Dave Miller says a lot, is we need to get proactive. But, capital raising in this space is difficult for a lot of reasons. Not that we're not successful at it, but to really tip the scales and get exponential amounts of money. The big check writers in traditional funds we're still a little bit too small for them to take all the, they would own a too big of a percentage of the company. And also our liquidity around the 5-year lockup, and then you have to redeem over time, means that we're just not a great traditional fit for $25 million checks. And that's how a lot of big money is raised in these spaces. So it means that we haven't gotten super proactive, because we wouldn't want to create a pipeline of farmers ready for us to help them and then have no money to spend.
And I do believe Claire put the email in the chat where you can reach out and just inquire as well. Okay, perfect. Follow up on some of the impact talk here. As a public benefit corp, what explicit public benefits do you offer?
Yeah,
did you just put that in there, Alex?
I did just put that in the chat. Yeah, that's all on our impact page. Please read our public benefit report. We'll be releasing a new one in May, June. Don't hold me to that. Definitely by June though.
Awesome. Okay. So this came up early, and I mean, you guys have addressed it, but I would love to hear maybe from the 3 different perspectives, like the farmer, the investor from Tanya, and Alex, from your perspective, is in the conversations that you all have with different stakeholders in this. Let's see, how does the impact that what you're doing, the impact it has on climate change, how does that factor into your conversations? Is that, I mean, I think Tanya, you said something about it being those are the kinds of investors you're looking for, the ones that, or those are the ones that come to you, or the ones that care to have that impact in climate change. Is that a big talking point to what you're doing, or is it more the farm story, the soil story for all of you?
I mean, I think there's a lot of ways we could go with that. So, I mean, I can just speak to the farmers that I talk to, whether climate change is used explicitly, often it is, or you just hear more and more stories about extreme weather that's happening. Many parts of the country had droughts the last few years. Other parts of the country, particularly the Midwest, where we have a lot of our portfolio has been underwater with floods. The derechos were pretty amazing. So yeah, resilience is really important to us. And we look at that a variety of ways in the due diligence process with the farmers. So how complex is their rotation might be harder to model, but provides a lot of revenue streams, provides a lot of diversification in case something makes it really difficult to have one crop go really well. And so we look at system diversity. We look at their past years, basically. So how have they done in similar situations? So if a farmer is looking to work with us after they've had a few bad years because of weather, we look at, can we call this the worst case scenario? Can it get worse from here? And then what can we do about that? What is your plan for this? And so, with that, we've really seen a bigger emphasis on conservation practices and long-term projects. So in a lot of places, people are investing in agroforestry as a mitigant through something like creating windbreaks to manage soil erosion and create better water retention. Cover cropping is kind of like a baseline practice at this point for our portfolio. But that certainly makes a huge difference in climate resilience. And support for those practices are really huge and stuff that we look at, and again, support through our soil restoration pool.
Sorry, I was having troubles unmuting. I do talk to the clients that I think would be interested in it. I do mention how, not only is it a human health and fitness type investment, but it also has potential benefits in terms of climate change and carbon sequestration in healthy soils. So, that's kind of how I position it in my mind when I'm talking to clients who might be interested.
I think the only thing I could add is just kind of the communication that I have to have with investors around this or advisors. I always try to be really honest with people that there's $1 trillion of farmland in the United States, and we have a, approaching $75 million portfolio. So we are a tiny drop, if that, in the bucket. And that, really what's key here is designing a financial model where we've created long-term perpetual land access for farmers to invest in the systems that will be able to sustainably grow food in the face of climate change, and ultimately, hopefully, provide a path for all the things that Tanya and Claire mentioned. But hopefully that this leadership leads to an expansion, and by proving the financial model out, that there can be, a fundamental shift in the way that we're funding farmers instead of, paying farmers subsidies and insurance to expand climate change, that we're doing the opposite. So I think that, there's really interesting stuff that's come out recently about how really clean air, clean water, healthy pollinators, healthy ecosystems, healthy soil, those are all proxies for the climate change fight. That ultimately, even if you can't necessarily measure carbon sequestration, that we see that the resilience of an ecosystem is better when you're installing all those other things that are happening on an organic regenerative farm. So that's I think how I usually engage with that. Under promise and over deliver.
Love it. Thank you. And I think we do have a few more questions, but we are out of time. I'm going to stay on just a little bit longer and let our guests maybe address some of those questions, including Tanya, maybe if you can share some of those books that you were talking about in the beginning that helped you get kind of the training in this space. I know we had an inquiry about that. I love you guys. You guys did an amazing job. This is a really interesting conversation. I love your work and what you're doing. And as you were alluding to, Alex, like if we can just expand this work for you all and for everybody in the space, we are on the right track. So I want to thank you guys very much for joining us today, for sharing everything that you did with us. I know there's so much more to share, so do feel free to reach out to them for more information. Thank you, of course, to Iroquois Valley Farmland REIT for making this webinar possible. And I encourage you again all to follow up and support their work. And a big thanks for all of you in the audience for joining us today and for your excellent participation in all the questions. That is really what makes this so much fun. We at RFSI hope you will continue to engage with our community as well, and we have lots of ways for you to do that. You can visit our website at rfsiforum.com to sign up for our bi-weekly newsletter. There you can also find our Raising Regenerative Agriculture and Food Investment Directory. How is that for a very long name? But that is a directory that we're building on that will help you find others in the space, other connections in the space, from capital opportunities to other partners that may be of use to you. So do check it out. And of course, as I mentioned at the beginning of the presentation today, we do have 3 events coming up the rest of the year, 2 of them in the next 2 months, May and June. So we do encourage you to join us for those virtually. And then, of course, all fingers crossed, hopefully in September, we can all see each other in person at the forum in Oakland. So you can find, again, all that information at rfsi-forum.com. And with that, we'll keep the line open just a little bit longer, but I will thank our speakers one more time. Thank you, Alex, Tanya, and Claire. And I will wish you all a wonderful and regenerative day. Thank you.
Thank you.
Yeah, thank you so much, everyone.
Sarah, did you want me to address that question you mentioned? Okay. It wasn't a books on impact or ESG investing so much. It was a book called Sapiens by Yoa, what's his name? Naval Harari. And in it, there's a chapter where he talks about capitalism and just how it's possible that it's grown so much that it's kind of overwhelming our planet's natural resources. And that was coupled with taking a class on values-based investing with a gentleman named Marco Evangelisti. And he kind of used that chapter in the book and some other resources to kind of make the case that, you know, investing the way we've been doing it may not be in our planet's best interest going forward. So that's kind of what I was alluding to when I spoke earlier.
And Marco's been a really great resource for driving people our way, even just to have an introductory conversation. And we're really grateful for him. And there's a great example of somebody who's advocating for the space, you know, to expand the amount of capital flowing into opportunities like this. So very important, like, connector for companies like us.
Wonderful. Thank you. I think we'll give it another minute if anyone has any other emails or resources they want to share, and then we will sign off for the day.
Thanks to all the Iroquois Valley investors who are here. We saw you, and thanks for coming and your continued support. And look forward to your valuation updates next week. And you too, Tanya.